Hey, what's up? Welcome back to Chalk Talks with Coach B. Today, I'll show you how to get paid when a stock does absolutely nothing. It just sits there and you collect. That strategy is the Iron Condor, the next chapter in the income playbook. This builds right on the vertical spreads video, so watch that first if you haven't. I'll link it up top. Here's the secret. An Iron Condor is just two credit spreads you already know how to build, stacked on the same stock. If you got credit spreads, you're 90% there. In one sentence, it's a short put spread below the stock and a short call spread above it, same expiration. You're selling premium on both sides at once. One side bets the stock won't crash through your puts. The other bets it won't rip through your calls. Together, they build a profit zone. The stock just has to stay inside. Draw out the profit and loss, and you get this shape, flat across the middle, sloping down on both wings. That bird with its wings spread look is where the name comes from. Let's build one so the numbers are concrete. Our stock's at $100 and we'll go about 45 days out, far enough out to collect real premium. First, the bottom side, the put spread. I sell the 90 put and take in $1.20. Then I buy the 85 put below it for protection, and that costs me 35 cents. So my net credit on the put side is 85 cents. That's $85 per contract. Strikes $5 apart. Now the top side, the call spread. I sell the 110 call and collect $1 even. Then I buy the 115 call above it to cap the risk, and that costs me 35 cents. So my net credit on the call side is 65 cents, $65 per contract, again $5 apart. Put those together and that's your Iron Condor. Total credit, 85 cents plus 65, $1.50. $150 hitting your account the moment you open the trade. Now the math, cleaner than you'd think. Max profit is the full credit, $150. You keep every penny. If the stock finishes between 90 and 110, both spreads expire worthless and the cash is yours. Now max loss, here's the key thing people get wrong. Your risk is only one side, not both. At expiration, the stock can't be below 90 and above 110 at once. It can only blow through one wing. So max loss is one spread's width, $5 minus your credit, $1.50, $350 per contract, defined before you ever enter, and your break evens. Downside, short put strike, 90 minus the credit, $88.50. Upside, short call strike, 110 plus the credit, $111.50. The stock can drift anywhere in that range and still not lose money. A $23 window on a $100 stock. Not bad at all. Let's walk three scenarios at expiration. One, the dream. The stock barely moves and finishes at 101, smack in the middle. Both spreads expire worthless. You keep the full 150. The stock did nothing and you got paid. That's the whole point. Two, the stock drifts up to 109, but that's still below 110. Still inside the zone, so you keep the full 150. You didn't need direction right, just inside the fence. Three, the downside. The stock tanks to 80 on bad news, blowing through your 90 short put and 85 long put. That lower spread is maxed against you, so your loss caps at 350. And notice, it caps. That long 85 put is your floor. Without it, a naked short put on a stock falling to zero would be a catastrophe. With the Condor, the worst day is a known number. So, why does this make money? Two engines. First is time decay, theta. You sold premium on both sides, and every day that passes, as long as the stock stays in your window, those options lose a little value. That decay flows to you. You're the house here, collecting as the clock ticks. Second is implied volatility. Iron Condors love high IV. When IV is elevated, premiums are fat, so you collect more credit or push your strikes further out for a wider, safer window at the same price. High IV is your friend here. Now, what can go wrong? I always want you sizing up the downside first. The risk is a big move. A sharp move through either wing turns flat profit into a loss, and a hard gap can hit max loss fast. And the honest part, most people skip. You'll win a lot of the time. The stock usually does stay in the zone. But you collect 150 when you win and lose 350 when you don't. Let losers run to max loss, and one bad month erases several good ones. That's why managing these matters more than picking them. So the mindset, a lot of traders don't hold to expiration. They take profits early, closing once they've captured about half the credit. and decide your exit before you enter. If the stock approaches a short strike, you've already got a plan to close or adjust, not panic. Always have an exit strategy. One more reason retail traders love these: defined risk. The most you can lose is that 350. So that's all the buying power your broker ties up. So that's the iron condor. 2 credit spreads, one below the stock and one above, giving you a window to get paid when the stock does nothing. You define your max profit, define your max loss, and let time and volatility do the work, as long as you respect the downside and manage the position. Quick reminder, this is education, not financial advice. I'm not telling you to buy or sell anything. Do your own research and know your risk tolerance. That's it for today. If this helped, hit that like button, subscribe if you're new to the Income Playbook, and leave a comment. What strategy do you want me to cover next? Good luck in the markets, no matter what stock you're into.